going on? What's going on, my people? What's going on? It's a beautiful day. I just want to drop a little jewel on y'all, man. When you get in the car, it's a couple of things that the lenders have to worry about as far as risk go or how they're going to do the loan. All right, they got to worry about the client. You got to worry about the income, the working history, the residence, how much you're paying to live, how much it costs to live, how long you've been there, your credit score, your profile, how much do you owe, how have you been doing with previous loans. All of those things the lender has to worry about. So the customer is one thing the lender has to worry about. The second thing is the vehicle. How old is the car? The year, make, model, miles. How old is the car? Any accidents on the vehicle history, the body style, things like that. So you got to realize a lender has to know what type of risk they're taking when they're doing a loan with you. Are you the risk or is the car the risk? One of those things can't be risky. One of those things has to eliminate the risk from the other one. Here's an example. You got bad credit, okay income, decent job time, you jump place to place with your living, you got a repo. You a little risky. So now what type of car do they want to put you in? Do they want to put you in an old car with a lot of miles that's inexpensive with one previous accident? Do they want to put you in a car that's not that really old with a lot of miles, no accidents? Or do they want to put you in a newer car with low miles and no accidents? I would say a newer car with low miles and no accidents because the car itself is not risky. Well, what is a risky car? A risky car to a risky credit profile means this car is old, it's gonna have problems. And people with risky credit profiles, bad credit, they usually have this mentality that I'm not gonna pay for something I can't drive. So now your car is old with a lot of miles, it breaks down. What you gonna do? Stop paying for it. Boom, there's a repo. Believe it or not, banks don't win off repos. They don't want to repo the vehicle. They don't want to pay somebody to come find the vehicle to have to get it and sell it at an auction. Now you owe them the balance of the difference of what they sold it from and what you owe, and you're never gonna pay that. So they don't really want that. That's more of a headache. Banks want to lend in a situation where they have a customer and a car that match up. The customer's gonna be able to drive the car for however many years is on the loan. They're gonna make their money off the interest, and it's a good situation, and that client is gonna come back to that bank. That's how they want to set it up. So you gotta ask yourself when you're buying a car, are you risky? Is the car risky? If both of those things are risky, that's not a match. Now you can counter that with a lot of money down, because if you put a lot of money up front, the bank is not carrying the whole risk of the loan.